Good afternoon, everybody, and welcome to this edition of our Weekly Think Tank for Feb 8. My name is Carl Capilingua. I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything big that happened from last week and have a look to what might be big this week. We'll do that after we talk about the Think Markets difference, which is substantial $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no platform or subscription fees for fantastic reasons why you should choose us for your next ASX share trade. There's the agenda on screen. Let's knock them off. First up, market moves. What a fantastic week it was for the local market, up 3.5%. Almost the exact move to the upside that it fell the week before that. And that was due to the GameStop fiasco, is the only way you could call it. GameStop, a lot of funds were short, price spiked through the roof. We had the Wall Street bets crowd buying up, and it caused some estimated as much as $20 billion worth of hedge fund losses. When hedge funds lose that sort of money, they need to cover it from somewhere. So they started selling other assets, and a lot of hot money markets were pushed down as a result. Our market got hit 4.6%, I think it was, off the top of my head from top to bottom. And there was this fear of systemic failure. So the fear that losses could spur more losses. Fortunately, this week, cooler heads prevailed. The GameStop ascent turned into a descent. In fact, that bubble has burst, and markets got their footing, and we can see the result of that here. Best performing sector, without a doubt, was the information technology sector, up over 6%, matching the gain in the NASDAQ. In the US, that's the tech stock index over there. Also doing very well. Financials up 5.6%, and we'll talk about the reasons for that a little bit later on. Also doing well, consumer discretionary stocks. They're riding that boom in local discretionary spending. Of course, telecommunications, many of the media stocks doing well. Same sort of theme there. Nine Entertainment, probably the key pick in that sector. Not so bad there on the energy sector, up about 3%. We saw a 9% gain in crude oil. And then they follow from there, not doing so well. Gold down 2.6%, and the utilities down about 1%. Gold prices coming down, and utility sector hit by downgrades for key stocks AGL and Origin. Having a look at the ASX 200 technicals, it looks very good at the moment. We are tracking a little bit higher through that 6853 area, and that breaks us out of, well, officially I think, breaks us out of this consolidation zone through here, and that is a really solid base from which we can push to those all-time highs. The other thing to note is that dip from last week, very frustrating for people that got knocked out or didn't get the cheaper prices they were hoping for around this long-term support. But the move from the low to the top and then back down from this launching point here could take us to 7093 this week. So that is the upside target to watch out for. Otherwise, long-term trend up, short-term trend up. Definitely want to stay skewed to the long side. And I think you want to stay skewed to the long side on the Nikkei. That looks fantastic. That market up 4% last week. The Hang Seng up 3.5%. The Shanghai Composite in China, a key underperformer there. They had some weaker than expected manufacturing and services data. I think that was the reason for that. As we mentioned before, the NASDAQ up 6% in the US, but the S&P 500 was not far behind. In Europe, we saw near 5% gains, and unfortunately, the UK missed out a bit, up only 1.3%. Metals on the London Metals Exchange were generally higher, just steel down, but it was down quite a bit actually, as we saw some news out of China about steel producing profit margins were shrinking, and I think that's caused the decline there. It's also put pressure on the iron ore price as well. Obviously, iron ore, the key component of steel making, but that was well off its lows for the week. So from low to high during the week, you're up probably about 8%. So not really depicted in that. It was actually better than that. And the iron ore price in US dollars probably didn't get the full benefit of that. We might see it catch up this week. Platinum had a good week, but otherwise precious metals were generally lower. Silver had a quiet week after a strong week before, as the GameStop crew tried to cause a short squeeze in silver. It didn't happen, by the way. Have a look at energy prices. They were up 9.3%, an amazing gain. We saw OPEC Plus come out and say that they are totally committed to sticking to their supply targets, and we had a fall in US stockpiles as well. It helped contribute to those gains. Natural gas also a big spike. The Australian dollar being helped by those commodities as well, up about 0.5%, but we could at the start of the week had a strong finish to the week, and that's why the US dollar is still showing a rise, but that was coming off towards the end of the week. By far and away, the biggest news in these market moves are here in the bond market. Typically, when bond yields start to go up, it's a concern for stocks because from a relative yield basis, risk-free bonds are starting to yield more in comparison to risky shares. It wasn't the case this week because the rationale is that we're expecting a lot of growth to come now in FY21 and beyond from the huge amounts of stimulus that both governments and central banks are throwing at the markets. We had a Reserve Bank announcement this week that they would continue to target low rates, and yet the bonds spiked. There was some very, very strong housing finance data, and I think that's contributed to that. And a 15 basis point rise in local bond yields is massive, and it would have helped the Australian dollar as well. So we're in a little bit of a phase here, and probably only temporary, where rising bond yields are not going to have a huge impact on the market, but there will be a tipping point where if they get too high, markets will start to fret about it. It'll be interesting to see where that might be. The other thing about those rising bond yields, they do help banking stocks, so of course they lend long term at higher rates. Okay, and then they borrow short-term at low rates. So if the bond curve steepens and those long-term rates go up, their profit margins tend to go up as well because short-term rates are being kept very low by the Reserve Bank. So good for banks, and that's why we saw that sector have a big rally last week. Now, having a look at this crisis versus the last crisis. History doesn't repeat, but it sure does rhyme, and it's rhyming pretty well right now. Look how closely these two charts are moving. Of course, we've got the S&P 500 last time versus this time, but hey, let's be careful when we get to this point here. We'll keep an eye on that one. It's just a bit of fun. Okay, having a look at the COVID situation, not much fun still for Europe and the US. The number of case counts, this is 7-day rolling average here, at elevated levels, but great to see those numbers coming down. They're also coming down in Brazil, in India, Germany, China, Australia. So that's very encouraging for the global economy. Not so encouraging for the local economy was a continued decline in ANZ job ads. Look, they did snap back sharply from that GFC low, so a bit of normalisation there, but certainly don't want to see that dip back into the negative. We'll keep an eye on that going forward. Contrasting that, some fantastic numbers there for building approvals. We also saw a big surge in housing finance. That is another factor helping the financial sector locally. And we saw a 10.9% increase in building approvals, and that was well ahead of the 2.5% expected, and also well ahead of last month's 2.6% print. Having a look at the Reserve Bank decision, they kept interest rates on hold down here at just 0.1%. They announced that they would actually increase their quantitative easing program, so that is their bond buying program, by $100 billion at the rate of $5 billion from April, and that was originally expected to end in April. So that is, again, great for the local economy and the share market as well. Not so great for us is the fact that the Chinese manufacturing and services PMIs are turning down again. Obviously, they had that V-shaped recovery, and a lot of this strength here was reflected back in our local resources stocks. But we can see on the services side of things, well below expectations and down from the previous month, and the manufacturing side of things down from expectations and also down from the previous month as well. We did see a bit of a spike in COVID cases, and that's probably having the impact there on the services sector. They are the official numbers, and just reflecting those, the KCN services, which is an industry group there, very similar results. Having a look at the corresponding data in the US, well, the drop there is in the manufacturing side of things, which came down from 60.5 to 58.7. That was below expectations, but the services side of things was better than expected at 58.7, up from the 57.7 previously and the 56.7 expected. Also better than expected was the weekly jobless claims numbers. First time in 4 weeks they are below 800,000, but bigger news out on jobs in the form of US non-farm payrolls. This is the biggest monthly update that we get on US employment, and we had 49,000 jobs created for the month of January, but most of those were in the government sector. So taking out the public sector, there are only about 6,000 private sector jobs created, and that is not fantastic, especially when you consider that originally we had 140,000 jobs lost last month, but they revised that down to a 227,000 figure. And that means on this trend, we are not tracking too well for jobs growth in the US. The unemployment rate actually came down, but that was because we saw the dip in the participation rate. So people not feeling confident enough to look for jobs, they're leaving the workforce, and therefore the unemployment rate came down. So not great numbers at all, but weirdly enough, it actually spurred the market to gains because the expectation is therefore that we're going to need more stimulus for the US economy. Having a look at how the brokers reacted to the events of last week, we saw Citigroup upgrade Fortescue. That was an interesting one, from neutral to outperform, but at the same time they downgraded BHP. We'll see that on the next slide. And it was a big pop-up in the price target, but only roughly to where it is right now. And that's the way you read this slide. So that's how much they increased their price target by, and that's how much, based upon that price target, they think is still left in the stock price. So on that basis, probably the best one might well be Deterra Royalties, which went from neutral to buy at UBS, a 3% price target increase, but still about 16% to the upside there for that one. And Amcor, which was upgraded, but actually saw a small decrease in the price, but still 11.5% to the upside seen there from UBS. Having a look at the downgrades, not so lucky. We talked about Origin Energy. They had a downgrade last week, and that hurt the utilities sector more broadly. We did mention that BHP downgrade from Credit Suisse, but they did up the share price target, so that's okay. And Wally Parsons, they disappointed the market as well with a worse than expected profit guidance, and Western Areas did that the week before, so some of those downgrades flowing through. Treasury Wine Estates also getting a downgrade from Morgan Stanley. Okay, biggest price target increases from the brokers last week. PointsBet got a big one at 52.2% to the upside, but not that much left seen in it from Credit Suisse. They're still neutral. Let's look at some of the more interesting ones where there's a bit more juice left in it. HT&E from Credit Suisse, they went up 30% on the price target, still about 12% there, and they're seeing an outperform on HT&E. And UBS on IGO, they did notch up that price target by 28%, still 17% seen there, and they're calling a buy on that stock. Not so lucky, we saw the biggest price declines coming for Worley, AGL Energy, another one of those profit downgrades. Origin Energy, we mentioned that one, and interesting to see CSL actually getting a downgrade also from Morgan Stanley. So where's the value in the Australian market? Well, overall, we're our PE, our 1 year forward PE is about 19.41, and we would typically consider that to be quite expensive. Anything up near 20 is quite expensive. 15 is kind of fair value, and towards 10 would be cheap. So we are still pretty expensive. Remember, P over E, we need the E to go up so that the PE overall can go down. We are about to commence, in fact, we commenced it last week, didn't we? First half earnings season. So hopefully we get some good results here to power that E up and bring our PE down. We're still cheaper than the rest of the world though. Where is the value sector by sector? Well, materials is still the cheapest, even though that PE has been rising over the last few months. The financials would be next, and that is despite that big spike up during the week. So worth having a look there, I think. And then properties probably next, and the rest are all sort of in the 20s. The most expensive sector is the one that did the best last week, and that is the information technology sector, because that key component there, Afterpay, has a very, very high PE, close to 100, if not over 100 by now, and that is causing that sector to have a very high PE as well. Okay, having a look at the technical side of things, and this is how we are tracking, or how the stocks in the ASX 300 are tracking against their moving averages. So 5-period moving averages is about a week out to 1 year over here. These are a number of periods when you take out weekends and public holidays, etc. So we've got nearly 70% of stocks pretty much across that spectrum above those moving averages, and that is very, very positive. It shows that many stocks are participating in this rally, not just a few, and it's actually better than the best level we had, which is the all-time high there back in February last year. So that's very encouraging, and well up from last week, which is down here. Of course, we were down in the doldrums back last week on the back of that GameStop spike, and you can see where we were at the bottom of the COVID lows. So we are way ahead of that, which is great. Okay, looking at the data coming up for this week, we certainly will be watching for the NAB Business Confidence Survey and the Westpac Consumer Sentiment Survey, local Australian data, on Tuesday and Wednesday respectively. Pretty quiet week for data overseas. We will get some inflation data in China on Wednesday, and then Wednesday night our time for the USA. We will have a speech from Federal Reserve Chairman Jerome Powell, and then the University of Michigan Consumer Sentiment Survey to end off the week. And that's going to end off our presentation. There you can catch all of our updates in the market news section of the website. You can follow me or the Think Markets handles on Twitter right there. And we will, on Wednesday, be having our 3 small cap stocks to watch in 2021. And you need to go to the webinars section of the website to register for that one. And also, feel free to register for the other ones on screen. The disclaimer before I leave you says that the content of this presentation is general in nature. We are a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So before you act upon any of this general advice, please read this carefully, or give us a call, or consult the website for further details. That's it for me today. Pleasure to join you. All the best for your trading until we catch up again. Bye-bye for now.